Until some years back, picking a mutual fund was quite difficult. Fund houses would change the scheme's mandate overnight. Just imagine this: you invested in a large cap fund, but some months later, you discover the fund has 60% allocation to mid and small cap stocks. I have even seen index funds deliver higher returns than the index itself. You might be wondering, how is that possible? Well, some fund houses got creative. They used arbitrage in index funds to earn better returns. All this changed in 2017 when SEBI put an end to all of this. The regulator defined each category of mutual fund and their mandate. It was a great move. This was one of the biggest reforms in the industry. Now, fund managers cannot deviate from their mandates. Despite this exercise, choosing the right mutual fund can still be tricky. Today, there are more than 33 different categories of mutual funds. If we want to invest in equities, there are 11 different categories. For debt, we have 16. And then there are hybrid funds, solution-oriented funds, and fund of funds. Most of these categories cater to specific needs of investors. Which one should you pick depends on your specific requirement. So we won't discuss which fund you must choose and when. But there are categories that you can definitely avoid. There are some categories that can be too risky for investors. You would agree that if you take higher risk, you must also get higher returns. But that's not how these categories work. In this video, we will discuss the 5 categories that we feel you must avoid. We will also discuss the reasons in detail. Let's begin. The first category is sector and thematic funds. Let's see how SEBI defines it. Funds must have at least 80% investments in stocks of a particular sector or theme. Here's an example to understand this better. There are about 15 funds that invest only in pharma companies or businesses involved in healthcare. The largest scheme in this category is Nippon India Pharma Fund. All its investments are in pharma companies like Sun Pharma, Cipla, Dr. Reddy's, Lupin, etc. Now, when a particular sector performs, the fund investing in that sector does extremely well. So it's easy to get swayed and invest in it. But you are better off resisting that temptation. That's because investing in such funds can be extremely risky as they expose your portfolio to a sector. So your returns will then depend upon performance of just that one sector. For this reason, the high growth in a sector fund is usually followed by periods of negative returns. Let's look at the data to understand this. We looked at the top performing sectors for the last 10 years. We found that the top performing sectors keep changing every year. None of the sectors like banking, energy, or IT were top performing sectors for 2 consecutive years. As we spoke about pharma, let's continue with the same example. We looked at the yearly performance of Nippon India Pharma Fund. We chose the fund as it's the largest scheme in the sector. Pharma was the best performing sector in 2015 and 2020. Nippon India Pharma Fund had 19% returns in 2015. Nifty 50 TRI delivered -3%. But in 2016, Nippon India Pharma Fund's returns fell to 10.58%. Nifty 50 TRI, on the other hand, was up 4%. You can look at the comparative returns between Nippon India Pharma Fund and Nifty 50 TRI from 2015 onwards. Do you see the volatility in returns? It rises much more than Nifty 50, but also falls much more. Now, let's talk about thematic funds. As the name suggests, these funds invest in themes. Some common themes include consumption, energy, transport, logistics, and business cycle. They may sound appealing. Many of these seem to be directly related to India's growth story. But there is a problem. We need to look at their portfolios to see where and how they invest. And when we do that, we realize that some themes are so broad that they are as good as a diversified equity fund. In other funds, the themes are so narrow that they are as good as a sector fund. Some examples would help here. Let's first look at a fund with a broad theme. Recently, many fund houses have launched business cycle funds. There are 5 such funds that you can see on your screen. Let's look at the top 5 holdings of the largest fund. The ICICI Prudential Business Cycle Fund has ICICI Bank, L&T, Reliance Industries, Axis Bank and HDFC Bank. As you can see, the top 5 holdings don't seem to be much different from a diversified large cap fund. So you're not getting anything unique in such broad themes. Now, let's look at a fund with a narrow theme. For that, let's look at ICICI Prudential Transport and Logistics Fund. It's the largest fund in its theme. The top 5 holdings of the fund are auto companies. You can see the names and holdings on the screen. In this case, the fund has a heavy concentration in one sector. Its returns are linked to the performance of the auto sector. Schemes with a narrow theme behave like a sector fund and have the same challenges. Now let's move on to the next category. This one may surprise you, but the next category we think you can avoid are small cap funds. We agree that smaller companies have the potential to grow faster than mid and large cap companies. That's why large cap stocks surge more when market rallies compared to large and mid caps. But at the same time, they also get hit harder when markets correct. This means they are more volatile than large and mid caps. More volatility means more risk. Obviously, when you are taking more risk, you want higher returns. But that doesn't happen in case of small caps. If you look at the long-term returns of small caps, you would find that they are unable to deliver much higher returns than mid or large cap funds. Let's look at the data to see if this is true. We looked at the 7-year rolling returns of Nifty Small Cap 250, Nifty 50, Nifty Next 50 and Nifty Mid Cap 150. Here is what we found. Nifty Mid Cap 150 Index and Nifty Next 50 Index offered higher returns than the Small Cap 250 Index. In any 7 years, the minimum returns that an investor in the Mid Cap and the Next 50 Index is also higher. Nifty 50 has delivered lower returns, but it is far less risky than Small Cap Index. Now, some of you could be thinking about active small cap funds. You might have a question. Does the picture change when we look at active funds? Let's find out. We looked at the rolling returns of active small cap funds. For 7-year rolling returns, we looked at the funds that have existed before 2015. There were 13 such schemes. Almost half of the active small cap schemes have outperformed Nifty Mid Cap 150 Index. Some have offered far higher returns. But with active funds, there is always one challenge. You never know which funds will continue their performance 7 or 10 years down the line. If you have faith in any of the small cap funds, you can consider them. For those looking at less volatility, you can stick to large and mid cap funds. Now, let's discuss the third category of funds you can avoid. Let me ask you if you know the difference between multi-cap and flexi-cap funds. For those who don't know, here's the background. Let's go back to 2017 and 2018 when SEBI defined each mutual fund category. At that time, multi-cap funds were allowed to invest in any stocks they wished. They could invest in large, mid or small caps in any proportion. But in September 2020, the regulator changed the definition of multi-caps. SEBI said that multi-cap funds will need to stick to a predefined market cap. So, they were mandated to invest 25% each in large, mid and small cap stocks. For the remaining 25%, SEBI gave them this flexibility to invest wherever they liked. Around 2 months later, in November 2020, SEBI introduced yet another category. Along with the multi-cap funds, SEBI said that fund houses can also have flexi-cap schemes. These flexi-cap funds were allowed to invest in any stock they wished. Now, we have two categories. One is multi-cap funds. It has some restrictions. Second is flexi-cap with no restrictions on investments. We believe that investors can avoid multi-cap funds and instead look at flexi-cap if they want to take exposure to companies across different market caps. The freedom under flexi-cap can help fund managers to move between large, mid and small cap stocks depending on the market condition. For allocation to large, mid and small caps, investors can choose to invest in funds from each of these categories. This way, you have the freedom and flexibility to decide your own asset allocation across large, mid, and small caps. The next two categories that we will discuss belong to debt mutual funds. The first category to avoid in debt are credit risk funds. As the name suggests, these funds take credit risk. Let's understand what is credit risk. I give you two options. Option 1 is government offering 10% interest rate. Option 2 is a small unheard company that offers the same returns. Which one will you choose? I'm sure most of you will opt for government security. After all, the government of India has your trust and you believe that it will not default. On the other hand, you might not be sure about the small unheard company. You may not have the same comfort. This means the government of India has zero or low credit risk. The small company has much higher credit risk. Credit risk funds buy paper that are risky. They are mandated to invest at least 65% of their net assets in papers that don't have the highest credit rating. So, the majority of papers that these funds invest in are not AAA rated. Fund managers buy lower quality papers as they offer higher returns. However, sometimes things may not work out as per the expectation of the fund manager, and we have seen that in the recent past. After the IL&FS crisis, many companies defaulted on their payments to mutual funds. As a result, some credit funds suffered huge losses. The purpose of debt investments is to provide stability to your portfolio. You should not lose principal after investing in a debt scheme. Therefore, it is better to avoid this category. Instead, match your investment horizon with the average portfolio maturity of the fund. For investments ranging from a few days up to 1 year, look at overnight, liquid, and short duration funds or even money market funds. For investments above 1 year, explore options like banking and PSU funds, short to medium duration schemes, and so on. We have a video explaining this, so do check it out. Let's move to the final category you can give a miss. We believe that long duration funds are not well suited for retail investors. This include long-term gilt funds. These funds require you to invest in debt papers with a maturity of at least 7 years. The prices of long duration papers are more sensitive to interest rate changes. So when interest rates go up, the prices of bonds held by these funds go up. So these funds start giving negative returns. But the reverse is also true. These funds have also delivered double-digit returns when interest rates fall. Looking at the data will help you understand what are we saying. We looked at the long-term gilt funds and long-duration funds, and here is what we found. These funds could fall in double digits in just 3 months, but can also deliver close to double-digit returns in a quarter. Now, consider a scenario where you have invested in one of these funds. At the time of your exit, these funds are down in double digits. It's therefore best to avoid long-term gilt and bond funds. So what should you do if you're looking to invest in debt funds for the long term? You can look at target maturity funds. These are passive funds that work like long-term fixed deposits. When you invest, you get an indicative yield. If you stay with the fund until maturity, you will get the returns close to that indicative yield. Let's recap. We discussed 5 mutual fund categories that can be too risky for investors. These include sector and thematic funds, small cap schemes, credit risk funds, and long-term debt funds. We also talked about multi-cap funds and why flexi-cap schemes are a better alternative. If you like this video, then do tap onto the like and subscribe button and share this video with your friends. And don't forget to subscribe to our channel. Till the next time, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.